let's go ahead and get this kicked off. Appreciate everybody joining this afternoon. We'll try to make it fairly efficient, hopefully informative, and a couple notes for you. For Q&A, we definitely would like to keep this fairly interactive. So there's a Q&A button along the bottom of your Zoom screen. And if you click on that and you'd like to ask a question, if you could type that into the Q&A section, we would like to be answering questions and having discussion throughout the webinar. So please we'll have a dedicated time at the end for some questions, but if you do have questions as we start to go through things, please don't hesitate to reach out. So with that, let's go ahead and get started. Today's October 25th, 2022. My name is Jim Denholm, founder and CEO of Ironbridge Private Wealth. It's obviously been a very volatile year this year. And so this one is, we think, appropriately titled the Jekyll and Hyde market. It kind of depends on what day we're looking at things, what week we're looking at things, as to whether things are good or bad. And we don't necessarily know that that's going to change anytime soon, but let's go through and talk about a few different things. So we'll talk about the S&P 500 index, the Fed and interest rates, the housing market, the mortgage rates, talk about some risks and opportunities in this market, and then look at current portfolio positioning and some things that we see could be happening in the near term. So like I say, thank you for joining us, and let's get it kicked off. So first, when we look at things, there's pretty much any environment is going to have bearish data and bullish data. This is a pretty interesting environment because there's definitely a tug of war between extremely influential bearish data and extremely influential bullish data. And like we said, the market is oscillating between this sort of good days and weeks and bad days and weeks. So if we look at the bearish data, the Fed, we've talked about this for kind of years. They're being very aggressive with the rate increases. It's starting to have an economic effect. It's having an effect globally. And, we'll talk about when we think that the Fed is going to pause. But they're still continuing to be very aggressive because of persistent inflation. We frankly thought we'd start seeing inflation data start to decrease a little bit, but every reading, seems to suggest inflation is still sort of stubbornly high. We are starting to see the economy weaken kind of broadly in some of the leading economic indicators and in the housing market specifically. We have seen a lot of currency volatility across the globe. A couple of weeks ago, there were some issues in Great Britain. The Bank of Japan last week had to intervene because of their currency. There's some pretty big kind of crosswinds in the global currency market. We're not going to get into that too much today. And then we still have this threat of war. The Ukraine and Russia war continues to kind of drag on. The risk of a Chinese invasion of Taiwan seems to be kind of growing in likelihood. So there's some pretty major bearish data out there that we've got to look at and be somewhat concerned about. On the flip side of it, not everything is terrible. Corporate earnings, we're right in the middle of earnings seasons right now. Corporate earnings have been fairly strong. There's been more beats than misses. This is a pretty important week for earnings. The tech sector kind of continues to be weak, but other areas of the market are pretty strong, actually. And balance sheets are pretty strong. So there's companies are in fairly good condition to possibly weather some near-term volatility. The consumer is still in pretty good shape. We have very pessimistic investor sentiment, which is a contrary indicator. It's more of a if it's when pessimism gets really, really high, that's actually a better time to buy. When optimism gets really high, it's a better time to sell. And we've already seen major sell-offs in areas. Facebook, for example, is down 83% from where it was last year. So, we've started to see some of these excesses get worked off. The couple things, look at 2008. They say history doesn't repeat, but it sure does look a lot like 2008. The black line is 2022, the blue line is 2008. And if we go from the peak of each market cycle, I mean, even each little wiggle looks pretty similar. We're here, if this analog continues, we'd have a few weeks here of an upturn. This is where Lehman went bankrupt and kind of the bottom fell out. So we don't really use this for any specific investment decisions, but it is something that we've kind of been watching all year, and it continues to be very kind of eerily similar. Same with the VIX. This is VIX in 2008 versus 2022. It sure looks like it's pretty similar. Going back to kind of late last year, all these little wiggles are pretty similar. It's kind of strange. So, if we did see this move higher temporarily in the S&P, a fall in the VIX, and then here's where Lehman went bankrupt and VIX spiked from 20 to 80. So something we should just keep our eye on, because markets do work in cycles. Cycles do somewhat repeat, and it's something we need to keep our eye on, but it's something pretty interesting. It looks like we do have a question about Fed raising interest rates. We're going to catch that in a couple of slides, and I think I'll go ahead and answer your question when we get there. So S&P 500, this is basically from late last year. Bottom line, the volatility is probably not over. The bear market is probably not over. If we look at what's happening recently, we've got kind of this support zone from the lows back in June, where it sort of bounced around. We saw it break down in September. It's kind of bounced around. This is one thing that could be a little bullish. Kind of have this sort of fake out lower where it breaks through support. This was the day a couple weeks ago when we saw just a massive kind of was down 2.5%, almost 3% in the morning, and it finished up over 2% in the afternoon. So this is a 5 or 6% swing that happened in one day. That can be pretty bullish, at least in the near term. And if we look, we've had kind of a similar pattern with some fairly big bear market rallies that have happened over the course of this year, where we sort of chop around and bounce, kind of chop around and bounce, chop and bounce, chop and a bigger bounce, and we're kind of chopping. So we have broken above this as of the close today. We finished at about 3860 in the S&P. So it could easily reverse. It could stay in this zone for a little bit, but for the first time in a little while, we might see a little bit bigger bounce. If you're fully invested, this is more of an opportunity to probably de-risk as opposed to sort of aggressively adding exposure. But it could still, if we see this bounce up right here, we'll just have to see how it handles. This 200-day moving average has acted pretty well as resistance, but we do have a bigger bounce possible over the near term. One of the things that we think is very important right now is staying very nimble is important. Staying very tactical is important. So we have gone through and added some equity exposure. We have kind of doubled our equity exposure here. And maybe we're going to see a little bit of a bounce, but by being tactical, and we say turnover is okay, because anything that we're adding right now, if the market does reverse lower, we don't want to get caught in this. We don't want to have, some increased stock exposure and think that we could be bottoming and get some signals that we could be bottoming, but the market is not ready to bottom, and we see some of a kind of the major area or the major period where the bear market starts to sell off. So something to be very cautious about right here is to stay nimble and be tactical. Shifting gears, looking at the PE ratios, not going to talk about this too much. We had a peak at 32, extremely overvalued from a historical standpoint in early 21. And PE ratios, so we started to see earnings fall earlier last year before the market started to fall. So now we're sitting at about 18.7 on a PE ratio. That's still pretty overvalued from a historical standpoint. If you go back kind of 80 or 90 years, there's some strategies that you buy when the PE ratio hit 12 and you'd sell when the PE ratio hit 18. We've had the 25% market decline. The PE ratios have almost been cut in half, and we're still fairly overvalued from a historical perspective. That said, earnings have been pretty good so far. Maybe this starts to hold up pretty decently, but just time will tell. Sector performance, kind of looking at a little bit under the surface of the market, we are starting to see some divergence start to happen. Now, energy was an outlier the first year. It was really spiked higher. It's been kind of flat to down since May. But what's very typical with major bear markets is you get this markets start to perform in tandem. So we saw that with almost every sector the first half of the year, really performing in unison. Since the summer, we've started to see a little bit of a divergence. So energy up at top in blue has been very strong. Healthcare has been strong in that it hasn't really declined much. And then you have the technology, consumer discretionary, and communications, which are basically the FANG stocks that have all pretty kind of in unison, sold off really hard. So actually seeing this divergence is somewhat bullish. So it means that there's maybe a little bit less indiscriminate selling, which is very characteristic of a major bear market. People sell without regard to what they own and what they're selling. So to start to see this divergence could be a better sign. We shared this in our a couple reports this year, wanted to do an update, but this looks at the bear market since 1950. The average decline was 30%. It lasted over 338 trading days, and it took 1.7 years to break even. Currently, on a closing basis, we're down 25.4 on the S&P. It's closer to about 28 if you look intraday. It's lasted 195 days. So on an average standpoint, it looks like we still have a little bit more time to go. And when we look here, the start of an inflationary cycle, 68 and 73 were the first kind of two bear markets. As inflation started to come in, we might be looking a little bit more like one of these two. That would suggest we probably have further to go before this bear market's over, at least 10 to 15% lower from here, if not larger. Shifting gears, Fed funds rate. This is the Fed funds rate going back to the early 70s. And when you see the Fed start to embark on pretty aggressive interest rate increases, they tend to break stuff, for lack of a more technical term. This was the 74 bear market. So, if we look, we went from 4% on the Fed funds rate to about 13. Pretty massive increase considering today we went from 0 to 3.25. But this caused a major recession. This was the 48% decline that happened through the 70s. They were very fast to cut rates back to where they were almost. Inflation started to persist, and they went from 5% up to 20%. I know many of you on the call will remember having mortgage rates at 14 or 15%. So this caused a major recession too, as Volcker started to get control of inflation. They had a rate increase in the mid 80s, resulted in the 87 crash, the rate increase that led to the tech bubble where they had to cut, financial crisis had to cut. This is about the only one that didn't cause anything major. Granted, COVID happened shortly after, but that wasn't a Fed related thing. So, the Fed tends to break stuff. Looking at where the Fed rate may settle in, this is a chart looking at the market's projection of where they think the Fed funds rate will end up. So we're at 3.25 right now. This green line is the current, future Fed funds futures curve. This yellow dot is the curve as of July 25th. And the reason I bring that up is that was about 3 months ago. And in July, the market predicted that 3 months from July, which would be October 25th, that the Fed funds rate would be 3.25%. And that's exactly where we are right now. So, the market is fairly good at interpreting things. They are projecting that we're going to get up to 5%. So we have a 1.75% increase still yet to go before next year. The Fed would start cutting rates down to about 3.5. So, they're projecting that at some point the Fed is going to cause a recession, is going to reverse, similar to how they have done in previous kind of aggressive rate heightening cycles. With this slide, I'm going to get to a question. One question, which this is a good question: if the Fed raises interest rates 2 or more times, will bond and CD rates match increases? Maybe. We are seeing this happen in the Treasury products. So, 6-month US Treasuries are 4.25, 4.3 right now. They've been kind of very, very predictably following the Fed funds rate. We have not seen CDs start to kick up as much. We have not seen corporate bonds kick up as much. We've not seen some of the money market products kick up just as much. It does take a little bit of time for that to flow through the system. So we're seeing it in Treasury bonds and Treasury bills, especially kind of 6-month, 9-month, 1 year. But we're not necessarily seeing that in other places. So good question there. So looking at kind of talking about rates starting to transition into the housing market, this is a fairly shocking statistic, frankly. This looks at the average 30-year mortgage rate. And we went from 3% a year ago. It's now 7.3%, a massive spike higher. And we've got another 1.75% potentially to go in rates. That could put mortgage rates at 8 to 10%, in the first quarter. That's going to cause problems, and we'll look at some data. With the spike in mortgage rates, it's reducing affordability. But one interesting thing that we have to kind of consider, and I thought this was a pretty interesting statistic, roughly 75% of existing mortgages out there right now have a rate of 4% or under. So, 75% of kind of homeowners, I would say, are kind of stuck. So on the one hand, that might be frustrating for some if they want to move. Obviously stuff happens where people have to sell their home, whether they relocate or downsize or divorce or health issue or whatever happens in life that causes somebody to need to change houses. So there's going to be natural kind of supply that gets out there. Demand will decrease with a 7.3% mortgage rate. but it kind of potentially keeps a lid on the amount of supply that could be out there with so many mortgages under 4%. Something to keep watching, but this spike is pretty incredible, and it's the highest since '01. Mortgage rates are. Housing affordability with rising home prices and rising cost of mortgage. It's no shock that housing is unaffordable. And we've seen just how this has just fallen off a cliff. Housing affordability is now at the same level as the peak of the real estate boom in 2006. Repeat that. It's as unaffordable today as it was in the absolute peak of the real estate boom in 2006. This also goes back to the early 80s, before we had kind of affordability at this low of a level. So it's no surprise that switching to home prices, that we would see home prices fall pretty dramatically. This is a Case-Shiller 20 city composite. So it looks at the largest 20 cities in the US, and this is a month-over-month percent change. So they're just hitting a wall right now. Again, not really any surprise, but this has been really in the last couple of months. We had some data today that as of August, home prices were still up year over year. So August they were up. We've yet to see some of this decline start to creep in. And it's probably only going to get worse if the Fed raises another 1.5 or 2%. Something we really need to look for. We've said this before, and housing is 15% of the U.S. economy. The consumer is 70% of the U.S. economy. It's hard to see us not going into recession if 15% of the U.S. economy is kind of screeches to a halt. So not there yet. We're not seeing the real dramatic price decreases, but it's something that we really, really need to watch, and I think is going to be kind of impact all of us. One bright side of it, with affordability declining, rents are starting to decline. That's been an issue for younger people in fixed income, people that couldn't afford a house. Rents were skyrocketing over the last few years. We have started to see for the last couple of months a decline in the rental costs. So renters are starting to push back against these high costs of renting apartments and houses. Bigger picture, leading economic indicators. This is as real time and as forward looking of an indicator that we can get when it looks to actual economic activity. And we've seen the leading economic indicators dip negative really for the first time since COVID. If you look, this chart goes all the way back to 1960. And every time we've gotten to a 2% decline year over year, that has been the average place where recessions start for the last 60 plus years. And we're almost there. So again, it's pretty hard to see that we won't go into some kind of recession right here. The data is just a little bit too strong, pointing in that direction. So really, when we look at some risks and opportunities, and we have another question about bull market, bear market, I'll get to that here in a second. This is sort of a macro view that we have. Now, granted, we are not trying to predict this. We have a system that allows us to adjust. But when we take a step back and look at maybe two likely scenarios, I think there's going to be one of two scenarios that end up playing out. One is that we do have a major bear market. The risks of a major bear market is we would have kind of a 30 to 50% decline in stocks from here. that'd be kind of a 50 to 65 or 70% decline in stocks from the peak. We're down about 20% from the peak right now. So a major bear market is going to be pretty ugly. There's a lot of risks associated there. If you own stocks, housing values would decline. We would have a deep recession or a prolonged recession. And in major bear markets, geopolitical risks tend to get exacerbated as political class tries to create an external enemy and not accept blame themselves. But we tend to see in major bear markets, it tends to see an escalation in geopolitical risks. Those conditions exist right now. And in fact, I'm under the impression and under the thought that if we are going to see a major bear market, we're not going to have to wait around that long. I think it'll probably start within the next 3 to 6 months. Beyond that, if we don't see a big kind of washout lower, if we don't see a major decline in stocks from here, and we can get kind of deep into the first quarter next year, February, March, April, these kind of conditions that exist right now where there is the potential for major dislocation, those tend to not persist for a real long time. They will work themselves out. Human nature tends to forget about bad stuff. And I have a hard time thinking that if we don't see a big decline that starts to accelerate fairly quickly within the next few months, then we're probably not going to see it. Unfortunately, we're not necessarily out of the woods there. I think we could end up seeing kind of a longer term choppy market. So there's some opportunities to both of those, but the risk if we called it a lost decade, and this is what happened in the 70s, markets were flat from 68 to 82. The Dow Jones had a 0% return, from late 68 to early 82. So 14 years in an inflationary environment where broad-based stock exposure didn't do anything. That'll throw off financial plans. So there's an opportunity cost in a lost decade. And some of the risks is that it's just a very choppy, frustrating market with no real direction. And it can frustrate, an investor like nobody's business. But each of these scenarios do have opportunities that present themselves. A major bear market actually has the most opportunity if you're prepared for it. Our clients are very heavy cash. We were essentially zero market exposure a couple weeks ago. So we're really not worried about what happens from here. And frankly, it would be a really nice environment to take advantage of, because if we get this massive decline in stocks and you are prepared to take advantage of it, if you are in cash while the bulk of that decline is happening, not only can you pick up fantastic companies for very, great prices, but after that, we would see an extremely long bull market if we saw some kind of major bear market or a market crash. So the most opportunities exist for those who are prepared for a major bear market. In a lost decade, that doesn't mean that there's not opportunities, because there are plenty of places in the 70s to make money. I think there's going to be plenty of places to make money in a future lost decade if that happens. So if we don't see a big sell-off, I think then the portfolios that our clients will have is going to be more yield focused. As interest rates go up, you just need to be getting yield into the portfolio. You can do that through some various kind of public markets, through high dividend stocks, through some fixed income, through CDs, through some other types of investments, pipelines and things like that. But you also start to look at private market exposure. Some private real estate should do well in an inflationary environment. A lot of different types, private debt markets, private equity markets that don't have the same kind of global price influence as the public markets do. And then you kind of combine this yield generating kind of a bulk of a yield generating portfolio with the more tactical public markets that kind of recognizes the areas like the energy or the healthcare that can do well in this kind of environment. But you're just not dependent on the overall stock market going up to, provide your financial independence or to meet your financial goals or to make money. So some, I think these are the two outcomes. I think it's either pretty ugly or it's kind of dull and sideways. So a question we had is, what marks the start and end of a bull market? And do you know this or have to wait later at a look back? Same for a bear market. Great question. The end of a bull market is much more difficult. They say you don't ring a bell at the top. They kind of ring a bell at the bottom. So if we look at the VIX, for example, when you see these massive spikes, there's a panic that you can feel. Now, this first spike in the VIX was not the low. We saw a dip and we saw a subsequent spike lower in the first part of 2009. But this is very characteristic of the end of a bear market. You tend to get this capitulation, which is sort of indiscriminate selling. There is a real panic that you can feel. If we go into this and we're having conversations with clients, my expectation would be that if we say, hey, we're starting to deploy the cash, we're starting to buy these stocks, the majority of the response would be, are you crazy? Why would you do something like that? Things are awful. It's panicky. We're not necessarily seeing that. I'm not hearing that from people right now. The VIX is still lower than it was in January. So we haven't seen sort of this very typical end to a major bear market yet. Makes me think that we probably haven't seen the end of it yet. But it's much easier to see the bottom of a bear market than the end of a bull market. Because things look good and there's a natural optimism to people, but good question there. Positioning update. So we're still very underweight stocks. If we look at our balanced growth and aggressive growth portfolios, a couple weeks ago, this was about half and we had some hedging. So we essentially were 90% cash balanced, 85, 88% cash growth. Same with aggressive growth. We've kind of doubled that equity exposure over the last week and a half. I would expect this to probably go down before it goes up too much. But we're still this is our target equity exposure and our current equity exposure as of yesterday. So, all of our strategies were very much underweight stocks. That's going to cause some underperformance if we see just a massive rally. But we are, we're buying things that are strong and hopefully we can hold those for a while. But if the market does decide to reverse, we're going to reverse that exposure as well. I don't necessarily see this happening in kind of the near future. So, but hopefully if things get better, we can start to really get more aggressive with portfolios. I just don't see it happening just yet. So, with that, I'd like to open it up for questions. Hopefully I didn't ramble too long. That's something that I can definitely do. So, like I say, look at the Q&A and type some questions in if y'all have any questions. And we'll kind of give a minute for somebody if anybody has any questions. Do I think daily trading is too impatient? That's a great question. It depends on what you're doing. I mean, we don't trade daily. I think people can be very successful trading daily, but that's an awful short time frame. You have to be pretty good at kind of short term trading, intraday kind of day trading. I think it is contributing to some of the volatility in the markets. Technology is contributing to some of the volatility in the markets. There's a lot of people buying and selling throughout the day. I think that's amplifying up moves and down moves. And follow up was, I mean, they want to see the bear market end. I think everybody wants to see the bear market end, but I think that's also a sign that we're not at the end. I looked at some data. I should have had, I don't have this chart right in front of me, but I mentioned earlier that pessimism was pretty high in the markets. That's mostly based on surveys. So people say they are pessimistic, but if we look at positioning, there is still equity inflows this year. We saw one of the highest. Bank of America has a survey, and they own Merrill Lynch, so they kind of look across all of their client portfolios and sort of make sense, can have data about what people are doing. And the last 3 weeks has been one of the largest inflows into individual stocks in their history. So on the one side, it's people are saying they're pessimistic, but not a lot of people are acting pessimistic just yet. So that could be a good thing. That could be a sign that there's enough flow into the buy side of things that it keeps a floor on stock prices. But what tends to happen is that you see the opposite. You tend to see massive outflows, a panicky situation, sort of indiscriminate selling, so that when that tends to kind of wash out everybody, where you lose an incremental seller, and then it doesn't take that much buying to start to push the market higher, and kind of enter into the new bull market. We just haven't seen that just yet. Another question talking about cash in portfolios, kind of what are we doing with that? What are the rates on that? We're using cash and cash equivalents when we look at being 75, 80, 90% in quote unquote cash. We are using some shorter term funds that do kind of 0 to 30 day commercial paper and US Treasuries. Those yields right now are kind of between 2.5% and 3.1%. That's pretty nice to be able to, a year ago, those were all zero. You couldn't get out of the market and earn anything. It's nice to be able to earn something. As we want to keep the optionality to put those funds back to work. So we haven't been doing necessarily a more broad-based allocation into individual treasuries just yet. But if we look into the first quarter and see that the Fed funds rate may be around 5%, and we're probably going to get closer to knowing if we're going to be if we're going to see another major move lower, or whether we're going to start this more choppy environment, then I think it starts to make sense to, if we can get a 6-month treasury paying 5 or 5.25, I mean, that starts to make returns a lot easier. And that's that yield portion that I'm talking about. Within a lost decade, if we've got 5 or 6 or 7% returns and kind of very, very safe investments, and we can go out and complement that with a 8, 10, 12, 14% yields in some private real estate or some other types of instruments that aren't a treasury or a stock, then we get to a position where we don't necessarily have to take a whole lot of risk. We don't have to have a whole lot of equity exposure, and we're just looking for yield and looking for principal stability. So, in a lost decade, it almost becomes pretty easy, frankly. It becomes a little bit easier to invest, as long as you're not in an index fund riding the waves up and down and end up at the same place. On that note, another question: how will you decide if it's a rapid recovery versus a long decade? I think that's going to be a tough one. Let's say if we don't, and I assume that you mean if we don't see a major bear market, and we see the market start to go up. This is what happened in the 70s, as you saw a 20 to 30% decline. It would get back up to about break even, see another 20, 30% decline. It gets back up to break even, and ultimately you end up kind of nowhere. I think if we don't see a major bear market, I think we're going into the lost decade. And I say that because we're 14, and markets work in cycles. And we're 14 years into a really quite good market that started in 2009. And that's pretty long for an average bull market. It's because the Fed kept rates at zero. We had COVID that sort of would maybe happen at the normal end of the bull market. A 9, 10, 11%, 9, 10, 11 year bull market. COVID came in and sort of threw a monkey wrench in everything. But we're basically 14 years into a bull market. And I just have a hard time seeing that really continue. I have a hard time seeing that we just go by the S&P 500 and we go up 10% a year for the next, 5 or 6 or 10 years. It's just not how markets work. Now it could, so we're not ruling that out. It's also why we want to, as we see some opportunity, we don't want to necessarily put our head, like an ostrich into the ground and just ignore things that are happening out there that could be more positive. Even if we're tilting more, in our mind, we kind of think that it's more bearish. There's been plenty of times where it looks like it should be bearish and it just simply isn't. But I do think that I think we've changed the market cycle, and I think we've changed it because of interest rates. If we look at the Fed funds rate, generally speaking, let's see if I can annotate this real quick. If we kind of generally look at this, we're in a 40-year declining interest rate environment. I think that cycle has changed. And if the interest rate cycle has changed, then we think that the equity cycle has probably changed. So maybe the interest rate cycle hasn't, but I would bet that it has. Another good question. So another one: what private investments are you using now and in the future? We have not been using much private investments just yet. Let's see if I can. I don't know exactly how to get that off, but there we go. If we haven't been using a lot of private investments, only because late cycle, we didn't want to get locked up. So if we go into a major bear market, private investments are not necessarily going to be shielded. Now, there's probably going to be some areas that will do well, but it's going to be tougher to find those areas in the future. So we've wanted to stay a little bit more nimble. For the last few years, our thought process has been, at some point, this market cycle is going to turn. We're going to be sitting in a period, we're going to be in a position of very high cash exposure, and we're going to go into the next market cycle, whatever that is. And the public markets in the next market cycle, we thought this years ago, were not going to provide the returns that our clients need and want over time. So we've wanted to keep this optionality and keep the flexibility to invest and take advantage of an environment that look like we're getting into right now, if we're not already in it. So what I do think we're going to end up seeing from a private market standpoint is you basically can classify it in three different ways. You've got private real estate, private debt, and private equity. Private equity is the most aggressive. The attractive thing about private equity, I think, going forward is that over the last 20 years, we've seen an increasingly difficult regulatory environment, and we're seeing fewer and fewer companies go through IPOs. So there's starting to be an easier access to private companies from an ownership standpoint. It's less costly, it's more transparent, there's more opportunities there, but that is more growth oriented. So that's not going to be for everybody. Private debt is an interesting one. I think private debt can go with a lot of portfolios. That's where you kind of hire a fund manager who's making private loans to companies that maybe can't qualify for a major bank, have some sort of issue where they need funds quickly. And there's a lot of opportunity there. Those yields are kind of 10 to 14%, typically. And then the private real estate, I think could be interesting in certain sections. So looking at couple different ideas that could be interesting in private real estate. One would be something like a senior housing facility. We've got aging demographics, got a lot of baby boomers, and really an undersupply of good quality kind of assisted living facilities. That could be an opportunity. Again, pretty low volatility, low correlation to the overall markets, 8, 9, 10% yields could go up with interest rates. And then some more specialty type investments, some smaller industrial use real estate, some different things that are a little bit more nichey. There's things you don't want to necessarily have exposure to, like residential real estate in the wrong area may be pretty tricky. Office space is probably going to continue to be pretty difficult. So we're looking at that kind of real estate, debt, equity as private investments. Another good question. Couple more. Okay. Speak now or forever hold your peace. Well, thank you everybody for joining. This was being recorded. We're going to put that together and send it out via email and on social media here by the end of the week. And we definitely appreciate you spending time with us this afternoon. Feel free always to reach out to me with any questions, jim.denholm@ironbridge360.com. This will go on our website. And then if you want to follow on Twitter, for those of y'all who do Twitter, I do Twitter some. But like I say, I appreciate everybody. And we look forward to speaking with you soon, and invest wisely.